Kim, it's good to see you. Today we are talking through 3 ways to maximize your retirement income and minimize your taxes. We've said it before, if you don't have a tax plan, you don't have a retirement plan. So this video
Exactly.
is for anybody who is nearing retirement age. We're breaking down a few strategies they should consider today. And first on your list, Roth conversions. Why is that?
Yeah, so we want to try to stretch that dollar in any way possible. And a lot of times that is done through what we call tax diversification. So this is often accomplished for clients through Roth conversions. So many people have saved for their retirement in the 401ks, 403bs, IRAs, and then all that money when they go to retire, when they take it out, is taxable to them at that time. A way to get around that is to do some Roth conversions ahead of time where we pay the taxes out of those buckets of money, move them directly into the Roth accounts that are going to grow tax-free going forward. And that can be a great strategy to utilize now, especially since we know that tax rates are set to increase in 2026.
Yeah, you're right. Great point. Next, you suggest that people have a carefully thought out RMD strategy. I think a lot of us think, all right, well, when I reach a certain age, I'm going to start taking those required minimum distributions, but that can leave you with quite the tax burden.
Yes, it's always good to understand what that will look like before you ever get there. So for some clients, they've done too good of a job saving for retirement. They've amassed all this money into those pre-tax accounts. And then when they get to that RMD age, they have to start taking those distributions. And sometimes that can force you even to go up to the next tax bracket. So if you're going to be someone that is in that situation, then potentially planning for that ahead of time is a great thing to do, especially for those that are charitable minded. Those qualified charitable distributions can be a great tool to utilize. That is actually available at 70 and a half. So you don't have to wait until your RMD age of 73. When you do a QCD, what that means is that you take that money directly out of those IRA accounts. It goes directly to the charities without touching your hands. And when it's done in that fashion, you don't pay tax on that money, which again can be a great strategy for both you and the charity.
Yeah, I really do like that idea. It's a win-win for everybody. And
Exactly.
last, of course, the biggest expense in retirement is often healthcare, which is why you encourage people to consider health savings accounts because they are uniquely triple tax advantaged. Explain what that means, Kim.
Yes, that means that we like to call those the triple threat. So you get the tax break funding the accounts. So you get the deduction on your taxes, and then that money that grows within the account, if you invest it, grows tax free and then is tax free when you take it out if used for health expenses. So it can be a great tool to utilize. You do have to have a high deductible healthcare plan in order to save money away in those accounts. But oftentimes, what we will tell clients is that if you have that available and you don't necessarily need to use those funds currently for those healthcare expenses, let those build up in that bucket so that you have a nice bucket for those healthcare expenses in retirement, because we know that you're going to have different expenses come up.
Right. All right, Kim, thank you. I think that having this conversation, I understand the earlier that people can have these conversations with a professional, the better. So, what's the best way to reach you with questions?
The best way to reach our office is to just go to our website. It's got all of our contact information on there, www.young-wm.com, and we'd be happy to help you in any way we can.
All right, Kim, thank you.
Thanks.